Good afternoon, students. Today we want to look at mainly depreciation, but that involves plant assets, natural resources, intangibles. So we'll look at all of these. These are also found in your blackboard. Let's go to where that is. Let's take a look. Show you under Test 5 Material. Okay, so the PowerPoints are under depreciation, and then your in-class and your homework is following that, and I'll also put the homework on the assignment tab. Okay, so let's take a look at this and see what we're talking about. First of all, a definition of plant assets would be that they are tangible. You can see and feel them. You use them in operations, manufacturing or selling your product. You do expect to use them over a period of time, much longer than a year, and we refer to them as either property, plant, or equipment, or all of those combined. Now, we want to also look at the term depreciation, because if you have a plant asset, either a building or equipment, you can, accountants don't like this term, but you can write it down. Let's take a look at this. Building, when you first either purchase it or build it, looks really nice, but over time it declines in value. You see it needs repair work there, and then it gets to the point where it's no longer useful. Probably a building would last, I don't know, 60 years or so before you have to tear it down and build another one. So during that time it declines in value, and we want to show that because according to the historical cost principle, which is what we have to use in accounting, you put the asset on the books at what you pay for it, and you don't change that for either a decrease or an increase in market value until you sell it. But through depreciation, you can show that it has declined in value. And technically, let's look at the definition there. I'll get through all of those. This is the definition I want you to know for test purposes. If you see it in multiple choice, do not put down that it's a write-down of the asset. Accountants don't like that. It's the process of taking the cost and showing it as an expense over the period that you use it. Okay? So what you're looking at is 3 items: the cost, what you paid for it; salvage value, which is what you can get for it at the end; and how long do you expect it to be useful. So those are your 3 values that we'll look for on depreciation. Now I want to go back to some of these slides that we missed, and one item I want you to know is that land is not depreciated. Okay, generally land increases in value for the most part, although there are some exceptions that I would think, such as if we have a landfill down going toward Greenville. If you have a piece of property down there near a landfill, it's probably gone down tremendously in value, and you can't get what you originally paid for it because nobody wants to buy a piece of land that's to build a house that's by a landfill. Okay, so that might be an item that you would think it doesn't decline in value, but for all practical purposes, they say that land depreciates, so we do not depreciate land. Now, I do want to point out to you the cost here. When you buy an asset, equipment, particularly, what you're going to put in the cost of it, historical cost that goes on the book, is what you paid for it, plus anything that you had to spend to get it ready to use. You see this dryer or washer, well, you have to have somebody that's putting it in, so they would include that in the price of it. You do not record financing charges or discounts and when you put it up on the books as an asset. Okay. Now, you don't have to memorize the following, but these are some of the things that go into land as far as increasing the cost of it on the books, and buildings and machinery, but you do not have to memorize all of that. Okay, just know that there are other items other than the purchase price that go into it. Okay, with that in mind, I want to take us to the homework problem, and to the in-class problem we're going to work. So pull that up and work along with me. There's several alternatives that you can use to record depreciation, which is taking the cost and spreading it over the useful life. We want to look at three of those: straight line, units of production, and declining balance. Now, for tax purposes, accelerated cost recovery is one that's specifically used for tax. There's another one that's used called sum of the year's digits. We won't use that one in here. These are the three that we're going to use. The problem that we have talks about the cost of this asset being $10,000. We expect to be able to sell it or scrap it for $1,000. That's your salvage value at the end of the useful life. We want to use it for 5 years. Now, if we're looking at units of production, this is a piece of equipment that's going to make 36,000 shoes. Okay, so that would be 18,000 pairs. So that one would only, that particular measure is only used in number 2 here. So let's go to our problem, and I have it down here. And we want to work it, starting with straight line, which is the easiest one. And this is the same information that's on this PowerPoint slide. Okay, so under the first method, straight line depreciation, this is the easiest, this is the most common used. What you have here is you want to take your cost minus your salvage value, and you want to divide that by the useful life. Okay. So the cost here was $10,000. Salvage value is $1,000. And we expect to use this machine for 5 years. So that would be $9,000 divided by 5. Every year we will depreciate this machine at $1,800 per year. Now, what are we talking about depreciation here? We want to make a journal entry. That's what we're getting this number for. So here's the journal entry that we want to make. I'm going to put it up here at the top. We want to debit depreciation expense, and we want to credit an account called accumulated depreciation. Now, depreciation expense goes on your income statement and reduces net income. Okay, accumulated depreciation is what we call a contra asset. Contra meaning it goes against the normal balance of an asset, and in this case it would be equipment. So when we get this depreciation amount every year at the end of the year, we would put in a journal entry, and this is one of those adjusting entries. If you go back and think when we did adjusting entries, when we put them on the worksheet, one of those entries was accumulated depreciation with a debit to depreciation expense. Okay. Notice there's no cash involved here. This is a non-cash entry. Okay. So again, the journal entry, and this is in your PowerPoints, is this entry done at the end of the year. And I want to show you a couple other things. First of all, on your balance sheet, I told you it was a contra asset. What that means is we take the asset machinery and we subtract accumulated depreciation on the balance sheet to get what we call a book value. Okay, book value. You need to know that word. Okay, so this is shown under your assets. It would be long-term assets, and this is how it would be shown. Okay. Now let's see. There's another one. This slide, what I want to show you here is that every year for 5 years, that depreciation amount, notice, is the same. I want you to notice that book value decreases every year until the end of 5 years. What would be showing would be your salvage value. What that means is when it's shown on the balance sheet at the end of 5 years, that book value would be $1,000, and this amount, an accumulated depreciation, would be $9,000. Okay. All right, so take a note of that. Now the next one is not going to be units. We want to do double declining balance because it ties in to the first one we did, and there's a 3-step process to get this one. Okay, let's down here to the side. or somewhere. Let's see. Step 1. What you want to do is you want to get the straight line rate. And what that means is you want to take 100% and you want to divide it by the useful life. And what that gives you is 20%, if this is a percentage. Okay. Now you want to double that in the second step, step 2. So double number 1. If you multiply this by 2, you get 40%. Okay. Now in decimal form, that's going to be 0.40 because your decimal would be between the 0 and the percent sign. So move it 2 places to the left. In step 3, what we want to do is multiply the rate in number 2 times the book value, and this is the amount without subtracting out your salvage. Okay, in this case we want to start with the 10,000. That would be the first year. So what that would mean is in year 1, the depreciation amount will be 4,000. Okay, and so in your journal entry for year 1, we want to debit depreciation expense for your 4,000, and we want to credit accumulated depreciation. And this is to record year 1 depreciation. Now, for year 2, it gets a little bit more confusing because we need to update the book value. If you remember, the cost of the asset, which is equipment, started out as 10,000. Okay. Now, accumulated depreciation in year 1 is 4,000. So what that means is your book value is 6,000 for year 2. So when you come back for the second year and you do your depreciation, you would be multiplying 40% times the second year's book value, and this should be 2,400, 2,400. Okay. So if you're making your journal entry for year 2, the amount that's going to go in the journal entry would be $2,400 for depreciation in year 2. Okay, so this is the amount that you would do for year 2 there. Now, we're not going to go past year 2 really, but I do want to show you. Again, this is in your PowerPoints. And I do want to show you how the book value changes. Okay. Here's your book value for year 2, like I told you, times your 40% gives you the 2,400. Now, if you kept on going, what you're doing is these would be your accumulated depreciation amounts. Okay, 4,000 plus 2,400, 6,400. You'd subtract that from 10,000. That's where you get the 3,600. Until the last amount you would have would be $1,000, just like in the other one. So keep in mind, again, I just want you to go, first year will be fine for your homework, but know how to do the several steps that we have here. And Let's see if we got everything. There's your steps. Okay. Now, this is the units of production method. And there's a little formula here. It starts out as straight line, but then it changes a little bit. And this is the one where the number of shoes ties in. We had 36,000 shoes. Okay, well, let's go up here and let's take a look at what we have in this problem. Let's come back here. For units of production, now this is where we use the 36,000 shoes. This is also where we have 7,000 pairs of shoes, or not pairs, 7,000 shoes that we're going to do this year. So let's start out with our formula. And mostly manufacturers use this. You start off with cost minus your salvage, and then you want to divide by the total units. Okay, that total units would be your 36,000 shoes up here at the top, not the 7,000. So let's start the way we did with straight line, 10,000 minus 1,000. But this time divide by 36,000 units, or shoes in this case. When you do that division, you get 25 cents per shoe. Okay, now that's how much for one shoe that we're going to depreciate. But we made 7,000 shoes. So you want to come back and you want to multiply times the number of units, in this case shoes, this year. Okay, and so this would be 7,000. So 25 cents times 7,000 means that your depreciation amount is $1,750. And remember, we're spreading the cost of this piece of equipment over the time that we're going to use it. But in this case, we're using based on the number of shoes. Okay. So your journal entry is going to be to debit depreciation expense, $1,750, and you want to credit accumulated depreciation, $1,750. And this is to record depreciation year one. And again, it's done at the end of the year. This is an adjusting entry. Okay. Now, that's also in your PowerPoints. There's the work. I want to show you something. Okay, now, the amount that you depreciate every year is going to be the same. The number of shoes you produce every year will not be the same. So it's very seldom that your depreciation amount would be the same as it is the first year. Okay, so the second year we made 8,000 shoes times 25 cents is 2,000 that we'd make the journal entry for. Third year, 9,000 times 25 cents. This is depreciation, $2,250. Just so happened in the fourth year we made 7,000 shoes like we did in the first year. So keep in mind, again, your book value is going to be different until you get down to that salvage value at the end and you stop. Okay, there is a homework problem you need to work through. It says another problem. Let me pull it up here. Okay, it looks like this. Another problem on depreciation. The asset's $42,300. Do the same three methods here. But before we leave the PowerPoints, you do need to know that for multiple choice purposes, okay, there's the problem for your homework. There is more material here. On natural resources, this is what I want you to know. What are natural resources? Well, it's going to be oil, coal, gold, gas, natural gas, diamonds, anything like that that's significant that you're getting from the land. Okay. We do something similar for natural resources. We call it depletion, this word right here. So two things I want you to know. Some examples: oil, coal, gold, diamonds, gas, natural gas. And what we do here is depletion. You would have a depletion expense, and accumulated depletion. Another thing I want you to know, and they use units on that. We're not going to do it, but do know those two items that I told you. The other thing I want you to know is intangible assets. We've talked about these, I think, before. You can't touch or feel them. They're usually represented by a piece of paper, exclusive rights to something, such as some examples would be patents, copyrights, leases, lease improvements, franchises, license, goodwill. And that's not like the Goodwill store. What that means is if somebody sells you a business and they're asking more than what the business is valued at, it's because they've developed clients in the area, and that client base, it means that they have goodwill with the community. And so they're asking you for an additional amount of money because they've already developed a client base there in the community. Usually this happens with some kind of business, store, something of that nature. And then trademarks or trade names. Okay, so patents are rights to invention, copyrights, rights to literary work. Trademarks would be, the Under Armour signal, the symbol, the Clemson Tiger Paw, the Pepsi-Cola brand, and all of those types of symbols that are used, as well as leases, lease improvements, franchises like McDonald's or Chick-fil-A, and licenses to run them, as well as goodwill. Now, know the examples there for intangible assets. Know that what we do with them is to amortize them. We don't depreciate, we don't deplete, we amortize them. Okay, and that's the end of the chapter. With that, your homework will be due at the end of Wednesday. Okay, Wednesday at 11:59. Take care.